Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Josh Levin, Chief Strategy Officer at OpenInvest, a venture-backed technology company dedicated to mainstreaming sustainable investing. Josh, it's great to see you again. Welcome back to Trade Talks.
Thanks, Jill. Great to be here.
2020 was an impressive year for ESG investing. You authored a piece in Forbes citing an incredible stat from a Celent report. Tell us more about that.
Yes, so if you're outside the industry, you might not know that inside the ESG industry, we're calling this the golden age of ESG right now. US assets that are employing an ESG strategy increased from about 12 trillion in 2018 to 17 trillion a year ago. So that was a 42% spike. And then in the subsequent year, according to BlackRock, global ESG mutual funds and ETF assets increased another 96%. So the whole category is blowing up, and you're seeing asset managers across the board scrambling for solutions right now.
You believe there are three unrecognized drivers in 2021 that make a perfect storm for change: politics, technology, and storytelling. Let's start with the political environment. ESG was a political football even before President Trump took office, but ironically, you think the Trump administration's influence on ESG was positive.
Yes, and I don't want to get in trouble here, but I would say that the Trump then Biden combination was a perfect 1-2 punch for the industry. During the Trump administration, there was an incredible amount of frustration, especially among progressives, over Trump and the GOP. And this forced a lot of people to seek other channels for change. So that includes through their finances and obviously also helping to catalyze the Me Too movement, Black Lives Matter. And this just got people super engaged, thinking about their purchases, evaluating corporate America and their social responsibility policies, and also where their money is going. Now, obviously, Trump's policies put a damper on certain products, especially in the retirement space, but he helped to spike demand. And that's ultimately what drives industry change. And then when you have Biden come in, he's unleashing the dams by reversing Trump's policies. So this provides a further accelerant in 2021.
You found that the main inhibitor to ESG uptake is not demand, regulation, or advisors. It's the fund vehicle itself, and technology is changing that. How so?
Yeah, people love to blame clients or advisors for lack of assets in motion around values-based investing. But I think this is wrong, and it's all going to change. So the key here is dynamic custom indexing is really going to upend the industry, and ESG is going to be a primary beneficiary. So direct indexing is when you skip the fund manager and you buy and manage stocks directly for a client. So buying the 500 stocks in the S&P 500 or 100 in the Nasdaq 100, for example, and you can customize that according to their goals, to their situation, and especially taxes, as well as their personal values. So this was traditionally the domain of the ultra rich, but what we call dynamic custom indexing, or DCIs, is when software does it automatically, which makes it essentially free and available to everybody. And I use the metaphor of the music industry transitioning from compact disc into streaming, right? So instead of getting a product, you're now getting a service. It's flexible, it's personalized. And for ESG, this is huge because traditionally, to move assets, you had to convince a client to switch, say, from a Vanguard fund to a Calvert fund. And that rarely happens. The iron law of wealth management is that people don't really change products and providers. But instead, we are starting to see a new paradigm in which clients are simply being asked to push a button, in which you say, okay, we'll keep your strategies, but if you push this button, whatever you care about, gender diversity, deforestation, that's going to flow seamlessly across your assets. And you don't have to, this may sound like a crazy talk, but you don't have to trust me. You can just ask Larry Fink, for example. I think about 10 days ago in his letter to global CEOs, he called this a tectonic shift. And he said that custom indexing is going to have such a powerful effect on the industry that every single CEO and board in every industry needs a plan in place for their stock prices being remapped by the fact that everyone is going to have their own personalized version of their index funds. So this is coming, and it's a big deal.
And the third factor is storytelling, which I think is interesting. Rather than massive data dumps, you believe ESG growth can be fostered through reporting on the client account level. Why is that?
Yes, so there's a ESG data industry that's been around for a long time, and that was all built for institutional clients. So telling clients your fund has moved from triple C to double B on your environment score, congratulations. It was never meant for retail. As ESG is mainstreaming, it is creating a market for client-first, retail-friendly reporting, and that kicks off a huge virtuous cycle because once clients can actually see and understand what's happening in their portfolio. So yes, we're a leading player in this. We deliver it to the individual client account in visceral terms. So you have avoided this many tons of carbon. It's equivalent to planting this many trees. Here's how many women on your boards, how many cigarettes. People go bonkers for this across channels. It massively spikes demand for ESG products if people don't already have it. And it also causes people to want to make personal changes in their portfolio. I didn't know I held all that Facebook or these weapons. Can I make those changes? And as this storytelling starts to roll out across national platforms and brokerages beginning this year, it's going to create an organic funnel into ESG products.
So Josh, in the end, it sounds like the demand of socially conscious investors and digitization are really what's transforming the industry.
Yes, that's right. I mean, like most things, it comes back to technology. ESG is both at the vanguard of how technology is changing asset management. It's adding new dimensions, it's requiring personalization, new reporting, but it's also a primary beneficiary of that change because once we modernize the asset management supply chain, and again, I go back to this metaphor of moving from compact discs into streaming music, then it makes it easy and seamless for anyone to incorporate their values on their assets. And at that point, who wouldn't? If it's going to have an immaterial effect on your performance, on your cost structure, you're just pressing some buttons, you can see exactly how it's shaping the world. You'd have to be pretty cold-hearted not to do it. So that is the benefit of technology that it's going to bring to values-based investing.
All right, Josh, great to catch up with you. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.